Welcome to the Teaching Tax Flow podcast, where the goal is to empower and educate you to legally and ethically minimize taxes paid over your lifetime.
Welcome back to the Teaching Tax Flow podcast, everybody. Today's a big day. We turned 40. Not 40 years old, but 40 episodes. This is number 40, and today we are going to jump into some state residency tax consideration. So what does that mean exactly? Take a guess at it based on that title. Me and Chris are going to have a great conversation wrapped around this. As you'll hear in the show, he went up and left me here in Michigan all by myself. He's down in Tennessee. Lucky fella. It's always nicer down there in Tennessee, a lot more fun. Shouldn't say a lot more fun, but in certain areas. So without going into too many details, let's, as always, take a moment and thank our sponsor.
This podcast is sponsored by The Mortgage Shop. Are you looking to qualify for an investment credit loan without jumping through hoops? That's easy. They have loans with LTV up to 89.99%. Exploring their products and discovering how they can work for you is simple. Just visit mortgage.shop or call 865-325-2566 and tell them TTF sent you.
Hey, everybody. Welcome back to Teaching Tax Flow, the podcast. How about that for a little introduction? I pretend like I'm a radio guy sometimes when I do these. Obviously, y'all heard a little preview about it. Today, we're going to talk about state residency tax considerations. So, in a nutshell, what state you should move to. Maybe you already live there. Maybe you live in the worst possible place. We're going to talk about it now. As always, my partner in crime, Chris Pacuro, is here with me. How are we doing, Chris?
I am amazing, John. This is going to be a fun episode because both you and I have moved from our home state to another state. You moved back to your home state.
And now you're just you're poking me, man. You're poking me. So it's all good. I'll take the harassment. I blame my.
But a lot of people especially after the pandemic, we've seen a ton more mobility due to work from home and that sort of thing. And we in the Teaching Tax Flow community and in our private Facebook group, Defeating Taxes, defeatingtaxes.com. Make sure you hit that up. We get almost every week we get some type of state residency tax question. So we wanted to do a podcast episode and then also give you some tips and insight into some of the resources that we use.
Absolutely. So one thing we really won't get into in this one, Chris, unless we go down that path, but this is definitely for another episode, is more business entity state. We'll leave this solely thinking about it from a residence standpoint. So obviously, Chris, like you alluded to, during COVID, a lot of people will say move to the East Coast from living in California. And, obviously some companies had a problem with that. Some of them embraced it and then had a problem with it, all kinds of stuff. But I'd say probably the best place to start off with, right? Like if I was, no joke, we have listeners from every single state within the US. So I'm sure this really applies to everybody. What might be a good place to start at? Say you don't live in any state right now. We'll say, hey,
well, you're in a state of confusion, probably.
There we go. Perfect. You were in a total state of confusion.
That is a very interesting point you just made. I want to touch on it in a moment, but let's start. We're going to focus on personal income tax, things that affect your persons, not an entity. It's interesting because what happens, we've had situations where someone, let's say they lived in a state, they bought an RV, and then they became a nomad. What happens is typically you're going to go back to the state that you had your closest connection to, which could be a bad thing. So if you're going to be a nomad, you might want to consider establishing residency in a state for a little bit, and then become nomadic. Well, the first thing we need to think about is, when are you subject to a state income tax? And that we know we have a ton of states with no state income tax, but when are you subject? And typically, when you live in a state, you're going to be subject to the state income tax in your state of domicile or residence on all of your income. Doesn't matter where you earn it. And if you have income that's tax sourced to a state outside of your state of residence, you'd be subject to tax in that state. That sounds like a pretty raw deal. So, John, let's say you're a resident of the state of Michigan. We talked about this a little bit when you hit that $1 million in the casino. But let's say that you take a job for 3 months in the state of Indiana. Stacy's happy because you're out of the house for a few months. But in the state of Indiana considers you an employee. Those W-2 wages are taxable in Indiana. You will pay tax in Indiana on that W-2 wage income. You will also be subject to state of Michigan tax. Now, you will not be double taxed, though. The state of Michigan will give you a credit for the Indiana tax that you paid on your state of Michigan return. I'm also going to mention that there are several states that border each other that have reciprocity agreements. So in my example, which is probably a bad example now that I think about it, you can actually just claim exempt from Indiana tax and make Michigan quarterly estimated tax payments. But the point is if you earn money in a state or you live in a state, you would be subject to some type of state tax. A misnomer is, like myself, I live in the state of Tennessee. We have no personal state income tax. Let's assume I have a rental property in the state of Michigan that has net income. First of all, slap me because I probably should have done a cost segregation study and I should have listened to my teaching tax flow courses. But let's assume I do. I would be subject to state of Michigan income tax, even though I reside in a state with no personal income tax. I would be required to file a Michigan non-resident income tax return and pony up the measly funds that I owe due to that state. Now,
so what you're saying there, though, is that you end up paying as a sum, you end up paying the highest amount between the two. So if you live in a state with a lower tax, but your income is earned where there's a lower tax, you're basically paying the highest of the two, in a sense, totally not getting into where there's city tax. That's
right. We're not talking about city tax. The thing to consider is you're not going to get double taxed on the income. Ultimately, you're going to pay tax on your state of residence rate.
Gotcha. Okay. Perfect.
It does get a little complicated when you start investing for our more seasoned investors. Let's say I invested in a REIT, and that REIT, or real estate investment trust, had properties in several states. And at the end of the year, I get a Form K-1, and I have a little bit of income in all those states.
And that's a great example too, talking about that, because we talk about certain levels of confusion. That's actually something that I've heard you guys talk about during urgent care. So if anybody's not familiar with urgent care at all, it's basically, in a sense, one-on-one or consulting, if you will, for more complicated tax situations. So that comes up a lot. Is that really, do you guys see that in your 20 plus years of doing this? That's always kind of been an issue, right? Is people just being kind of confused. If, as you spread your wings and, like you'd mentioned, you're investing outside of your state of residency, you kind of get into, would you call it gray area or just confusion?
It's really more just tax compliance, because in general, you've got to weigh the cost. If you have a K-1 and you have $100 worth of income allocated to the state of Arkansas, you probably are under the threshold for filing in Arkansas. It's not going to give you any benefit. You don't have any tax withholding, so you might not file for that $100. That being said, what you need to look out for in those situations, John, is when you have state tax withholding in those other states. Some states, actually, if you sell a property and you're a non-resident, California, probably the biggest culprit, withholds income tax from the sale, and you have to go back, file a California non-resident tax return and claim some of that withholding back.
Okay. And kind of looking, I would think of 20, wow, I feel old. 20 years ago, I was actually going to take a summer job working on a long lining on a salmon boat in Alaska. And I remember the guy was talking to him on the phone and saying, well, you don't pay any tax. You work in Alaska, you don't pay any tax. So technically that's not true then, because I was living in Michigan at the time. So I wouldn't pay state income tax to Alaska. I would basically pay it when I returned home. Because I remember him very vividly telling me that. And it's probably just his way of pitching to a kid at the time. But is that true?
Yes and no. That's why you have to jump into teaching tax flow, John. But the answer is, he is correct in so fact that you don't pay any state tax to Alaska. What he doesn't understand is you still owe state of Michigan tax on that income. That's where it gets sticky. Unless you established yourself as an Alaskan resident, which is a great segue to how do you establish a domicile in another state? We have a lot of people moving from these higher income tax states, especially retirees, not always retirees, but to a no income tax state because they are concerned about how is their pension going to get taxed, how are their IRA distributions, investments. And sometimes they actually are what we call, if you're from Michigan, you've heard the term a snowbird. A snowbird is someone that leaves the northern states during the winter months and goes south and basically has two residences. The question is, let's say you do have two residences, which one is your home residence? And if your home residence, let's say, is state of Florida and you are living half the year in the state of Illinois, it would behoove you, and we have a client with this fact pattern, to be a state of Florida resident, not a state of Illinois resident. So there are certain ways to establish if you are a state resident. The state of Florida really doesn't care because there's no state income tax. But the state of Illinois, if you were audited, would be very interested in determining if you're a legitimate Florida resident.
And when you change residency, I don't actually know the answer to this one. When you change residency, is there, as dumb as it is to call it, like a waiting period? Like say you move out of state for college, right? They usually say, hey, you have to live here for a year before you qualify for in-state residency some places. So is it immediate, like, hey, I can go to the Secretary of State or the Treasurer's office and say, hey, here's a utility bill, here's my other documentation proving it, and they spit out a new driver's license, and all of a sudden you're a resident? Or how does that process work from a tax standpoint?
Right. So let's use the example, you're leaving Illinois and you're moving to Florida, right? What you would do is when you sell your house in Illinois, you write a Dear John letter and send it to the state of Illinois and piece them out with a certain finger when you hit the state line and say, I'm not paying tax anymore. No, I'm just kidding.
And it's not the thumbs up.
How do you establish domicile? There's really no formal way to do it. When we have a client that changes states, what we would do is we would file a part-year state residency tax return for the state you're leaving. Typically, you're going to file a return, and you're going to self. It's not like anyone knows you left, right? It's going to be something that you're self-policing, if you will. Obviously, you could be examined, but you're going to just say, I lived here from January 1st to June 20th this year, and my income was for the first half of the year approximately is taxable in the state of Illinois. The second half is not. So how do you establish that? First thing is you've got to spend more time in the state that you're going to over a 365-day period than the state you left. It's called the 183-day rule. Some people plan around that. And it's interesting because think about a snowbird that spends 6 months and 2 days in Florida and 5 months or whatever days in Michigan. And in the middle of their stay in Florida, in the beginning of October, they get evacuated by a hurricane. Now they're not in Florida anymore. There are rules and such, and depending on where they flee to, and typically we don't want to get into the weeds too much, but those are just crazy little scenarios that can happen. In general, you're not going to lose your residency there. But the things that you could do to establish domicile is going to be employment location. Again, we have a lot of virtual employees, but changing your mailing address, the big one, changing your driver's license and your vehicle registration to your new state, updating your voter registration card, those are huge. Back in the day, it used to be, establish a bank account, but now, many of these banks are in several states. But that voter registration and the driver's license is really important. Any type of, one misconception though is that you have to buy a property to be a resident of a state. You can rent. There's nothing wrong with renting and you could own a home in Michigan, rent a condo in Florida, and be a Florida resident because you're there longer.
And again, not getting into the weeds, right? Like say, I actually have a handful of friends that are, pipe fitters, make excellent money doing this, and they're on 6, 7, 8 month contracts, and they have a motorhome, right? So technically that motorhome is in permanent real estate. They're not renting, they're not doing this. So basically it comes down to if they want to elect for domicile in that state, like you had mentioned, kind of knocking through a couple of those checkpoints, but then they'd move around.
Yeah, but they would have to establish an address there. They'd have to change their voter registration. They'd have to change their driver's license, re-register their vehicles, enroll their children in school there. Those are a lot of things to consider.
And at some point, it becomes the juice is not worth the squeeze, right?
And exactly. That's how you have to establish a residency in the new state to not be a resident in the old state.
Makes sense.
Typically, people with families, it's a lot harder unless your family's moving with you and the kids are going to go to school. Obviously, we have people that homeschool. There's a lot of fact patterns. And also remember that the states, especially these high tax states we're going to talk about in a few minutes, they are putting resources together to audit people. And it's really easy for a state to, if they think you're a resident, to subpoena your credit card records and figure out how many trips to the grocery store you did in the state of New York versus the state of Florida. The state of New York is very aggressive in the state of Florida in finding residents that are allegedly now Florida residents because the state of New York has a significant income tax. But those are really the considerations when you're thinking about how do you establish that you actually live in a state.
And is there any reasoning why a lot of the states with lower state tax or income tax are in the South? Is it to entice people to the warmer weather? So, and not all of them are down there, but there's a higher concentration of them, right?
Well, so you nailed another point. I mean, now that we've talked about when you'd be taxed in a state, how you establish domicile in a new state, let's talk about the different types of taxes. In essence, the states in the Southeast or the Sun Belt are operating in a lot healthier financial condition than some of the other states. Just because they have no state personal income tax doesn't mean that they're not generating a lot of revenue through other taxes. So the things you want to consider on the personal side is going to be your income tax, sales tax, property taxes, personal property taxes. That's like the vehicle registration fees, then also transfer taxes when you sell a property. In general, the states that are doing very well, and we're going to talk about that in a couple of minutes, have a higher sales tax or occupancy tax, tourist tax, whatever you want to call it, to pay for the people that live there. I live in the great state of Tennessee, and we have no personal income tax. We have a 7% state sales tax, which is a little higher than normal. And then each county has a county sales tax they tack on. Ours is 2.25%. So that's hefty. You don't pay sales tax on everything. Yet we have a significant, though that's a higher sales tax, we have a significant occupancy tax. So when you think about Tennessee going from west to east, you still have a decent amount of tourism in Memphis. You've got some conferences there. You have some festivals. You've got Elvis's old house, which I can't remember right now. And when we listen to this, I'm going to slap myself. Graceland. Nashville. I mean, you've been here several times. Many of the listeners have. It's just booming, and it's been that way for almost a decade. Other than Vegas and Orlando, probably the third largest convention center crowd. Every week there's conventions. There's always stuff going on here. Mm-hmm. So you're talking about sales tax.
And it's almost, when you think about moving, it's you almost got to be really good and really crafty with a spreadsheet, right? So even when I was in South Carolina, now looking back, I'm like, even when you went and bought a new vehicle, I forgot what the number was, but your purchase tax was capped. So it's like a couple $100, right? Where in Michigan, it's not. Pay your sales tax on that. But every year for my registration, it was $600-$700. Where I'm telling my friends back in Michigan, they're like, "What? Are you out of your mind? Like, it's $105 or whatever I paid here instead of $780 or whatever it was." But then you're right. Like I remember, like, I was in Charleston County, so we had our state tax, which I think was, I could be wrong, 6% at the time. Then there was a 2% county tax, but then the hospitality and tourism tax at certain areas around there was 14.5%. So you'd go to a restaurant or a bar and you look at your bill and you're like, "Holy crap!" Be like, they're getting me here. But then there's, a lot of the guys too that would, lucky enough to have multi-million-dollar yachts that are getting huge tax bills. So you're right. There's a lot of things into play. I mean, real estate property tax is much, much lower, but they get the money regardless.
Well, the state of South Carolina does give you a credit on your return if you keep track of how many gallons of gas you utilize, which is a pain in the butt. Now you can use an app. We talk about tax agencies are your involuntary business partner, and we refer to the IRS a ton, but the state and local taxation is another issue. And then, to finish up with Tennessee, the most Johnny T. I don't know if I told you this, but most visited national park in the United States. Most visited national park in the United States is Smoky Mountain National Park. So you have a ton of people in Gatlinburg, Pigeon Forge, Sevierville. It's huge. So all those tax dollars are getting, sales tax dollars getting poured into the state of Tennessee.
And you mentioned too, like a lot of them are operating at a much healthier financial status, right? So a lot of that, it's just not the tax that they get from that. It's, it goes into the economy. So there's a lot going on with that, which again, I'm sure kind of offsets taxation decisions, right?
Yeah, absolutely. It's pretty telling on, what states are going to do what. And we use, so now that we talked about different types of taxes you need to consider, the other things non-tax would be car insurance. Your vehicle insurance in Michigan is probably a lot more than in the middle of Florida, in Orlando. There's no snow in Orlando. There's, it just depends. But your property taxes might be higher in one place than the other. So one of the resources that we use, we're going to link this up, and we do a lot in that Defeating Taxes Facebook group. We post things all the time that we find are interesting or sometimes just funny. Is the website taxfoundation.org. It's a nonprofit, bipartisan organization that breaks down tax code and tax law. And they have a whole section on state tax. But they went through and they ranked different states based on their individual income tax, sales tax, and property tax. And they have nice graphs. So, we if we look at tax, we kind of always poke fun at California, right? But so California is ranked. So you do want a low rating. You want to be number 1, number 2, but California is ranked number 49 in individual income tax. New York's ranks 50th. So 49,
which is the no zone. That's what you want to avoid.
No zone. In state sales tax, California is 47th. New York's 43rd. So they have the worst in income tax and pretty much the worst in sales tax. And in property tax, California is 19th, so not too bad. New York's 49th.
We need to get some guests on this show and call it like Battle of the Borders or something, and have a couple of guests on from different states and let them battle it out and justify why their state's better.
Well, and you've got to think too, when you institute a sales tax or consumption tax, we talked about this many times, you are also filling that tax gap. So let me give you an example, John. You hire a painter. We're going to call him Luigi because Mario gets all the love. Luigi comes over your house and he says, hey, I could do your job for $2,000 or I could do your job for $1,500 cash. You probably pay him $1,500 cash. Luigi goes out, paints the house or the room, whatever, and he's done. He probably doesn't report that on his tax return, although the teaching tax flow team really encourages you to. What happens if you have a state income tax? The state gets nothing. What happens if the state has a state sales tax? Luigi's paying for the paint supplies, the gas. So that's where that consumption tax, the states with seems to be have a higher sales tax are doing better than the states with the higher income tax. Or you could be crappy at both.
Right. Which then it's just bad leadership. No, that makes sense. That's a great example too, because some people think like, oh, somebody didn't report this on their tax, that the state is completely getting zero. Which it's unfortunate because they're getting shortchanged.
For good on projections.
But it's like, we're good.
Let's talk about. Give me a state, for instance, that ranks high, like Florida. Florida's tied for number 1 best in income tax, so it doesn't have an income tax. In sales tax, 21st, so a little better than average. Property tax, 12th. So really, really solid. So yeah,
and then there's some funny ones in there too. If I remember right, we were looking, really at some of the graphs that they had on that taxfoundation.org, and what was probably the funniest one that we came across?
Right. So we talked about different types of tax considerations. We even talked about vehicle insurance. We looked at state sales tax per pack of cigarettes.
That's right. That's what it was.
Okay. State tax and the tax foundation, the lowest that we found was Georgia. Actually, I'm sorry, Missouri, 17 cents per pack is a sales tax on 17 cents per pack. The highest we found was the state of New York, of course. Well, California is getting jealous. We keep bagging on New York. $4.35 per pack. Now, you might want to chuckle at that, but if you smoke a pack a day, that's an extra $1,500-ish a year that you're paying.
And that's is that I don't remember either or if it was or wasn't even noted on there specifically, but so that's a monetary set tax. It's not a percentage, right?
Correct. It's per pack.
Okay.
Missouri 17 cents is the lowest that we found. New York, you pay $4.35, and that's just a flat. That's not the cost of the actual pack. Obviously, that's just the state tax.
Right. And then it was something crazy on there too, if I remember. Not to poke fun at it too much, but there was a very high smuggling rate based on that.
So the smuggle rate in New York, according to the tax foundation, is 53.5%. So over half of the packs of cigarettes in New York are smuggled in.
Oh man, it's
you could maybe
imagine that, having like a whole like a SWAT team based around tobacco smugglers at state borders. That's it's funny, but not funny.
Well, I don't. Anyone that watches Seinfeld remembers the episode when Kramer rented like a U-Haul and did the math or something, or stole a postal truck to return the cans to Michigan at 10 cents a can from the state of New York. Of course, it went poorly for them.
Of course, yeah, it wouldn't be good TV if it went well.
But those are just some of the fun things. But again, really, it's interesting. Really fun to just take a look at And yeah, I mean that's those are things to consider. So
basically the gist of this episode is really just, I mean, obviously we have fun kind of diving into the details, but really kind of getting across that, you have a lot of options. Literally, you have 50 options when it comes, if you have the freedom. I mean, obviously there's a lot more that goes into it than just selecting a place to live in based off, tax rates and taxation across the board. But it is something to consider, especially if you're a high income earner, right? Like that plays a very, very, very large part in that selection.
Absolutely. I mean, you're looking at the high income earners. Well, we got to throw California. The highest state income tax is 13.3%. That is a significant amount of money for state tax. So yes, obviously we say don't let the tax tail wag the dog. Put a bow on this, there are several different scenarios where you would be even subject to any type of state income tax. We gave you a list of the considerations when establishing new domicile. So, hey, I don't like my situation. I'm looking to relocate. How do I establish residency in another state? Or some people legitimately have two residences. Maybe they want to establish residence in one more or the other. Those considerations were put out there, and all the different types of tax, not just income, sales, property, personal property, transfer tax, cigarette tax, if that's a factor.
Mm-hmm. Mm-hmm.
And then,
well, based on that, now you got me a little sour, but I think we went into a lot of stuff. So maybe I'm just going to click off on you and you go enjoy your tax-free, your no state income tax. But is there anything else we want to add here? I know we kind of went into a lot of good detail. We'll obviously post some of the links in the show notes and send you guys directly to there. Maybe we'll post one in there too, just for the tobacco tax, just because it's kind of interesting to see how it rolls. But
well, before we put this episode up in smoke, here's what we're gonna do.
There you go. I love it.
One serious note before changing state, especially for people that are retirees. look at the state to make sure that it conforms with federal estate tax rules, right? Because we know that the federal estate tax exemption is very high. Not every state conforms to the federal estate tax exemption. So that's my last piece of advice. We're going to start jumping into some more. We had our living trust episode already. We're going to start diving into some other estate planning topics. And then that's a wrap.
Alrighty. Well, thank you everybody as always for joining us on this. Chris, thanks for letting us dive into your brain onto this. I know we kind of casually talk about this, over dinner, drinks randomly and travels, but it's really interesting. If you guys do have some time, get onto that website again. We'll put the link in there for the tax foundation and just kind of mosey around in there. Even if you have no plans of changing residency, just get in there, spend a little time and kind of clicking through. Of course, after you listen to some of our other podcasts, listen to those first, enjoy all of those. I know we're getting up there in the numbers, so check all those out. Check out the Tax Foundation. Post any questions you guys have in the Teaching Tax Flow community there on Facebook. They're on our page as well as the Defeating Taxes group. But again, we will see everybody next week. Thank you as always. Hey everyone, John Trapolsky still here from the Teaching Tax Flow team. Hopefully you enjoyed this episode as always. Me and Chris, a little banter back and forth as always, keeps the soul in good spirit, as some may say. But since you're still here, think about that, what we talked about, right? If you've considered moving to a different state, maybe it's for the weather, maybe it's for family, maybe it's for business. There's actually a lot of benefit to planning ahead for that move. So before you call up U-Haul or call up that moving company, start packing those bags, searching on Realtor or Zillow, looking for that house or a condo, that apartment. Take a moment and kind of look up some of those details. I know we dropped a lot of knowledge, we should say, or fun little facts regarding certain states and certain taxes that are associated with certain luxuries in life, as we can call it that. But definitely go back, take a peek at those links. We'll drop them in the show notes here as mentioned. Just have a little fun with it. Take a peek at it. If you do know somebody maybe across the country or just maybe one state away, give them a hard time if you look on there and call them out and say, do you know that you're paying this much more than we are just living over here? Have a little fun with it. So until next time, everybody, thank you again for joining us. Thank you for these great topics that give me and Chris and the team here at Teaching Tax Flow and our fantastic guests kind of the steam to trek forward, have these great conversations, and dive into these fantastic topics. So we thank you from the bottom of our little tax heart, and we will see y'all next week.
The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer.